All right, welcome back, New Level Realty. So I get asked this question a lot. What do I look for when I start to either gather research to invest in my real estate properties, or just what do I look for in general when invested in real estate? And that's an awesome question. Now, I got my 3 quadrants of real estate investing. Okay. However, there are a lot more other items that go into it. These are the main 3, and we can kind of narrow it down and kind of slim down the actual strategies and what we look for. But this is basically it. All right. So as you can see, I got the 3 quadrants, and I got my biggest point that I want to cover up top, and it's the biggest box, and then you got these 2 other boxes. So number 1, right off the bat, your cost basis. Okay, and it goes right along with other investment videos that we've done where we talk about buying under the intrinsic value of whatever asset that you're trying to acquire, whether that's stock market, bond market, real estate, gold, or whatever. You want to assess the value, and then you want to try to buy below because you're going to have a margin of safety that's going to protect you. If something goes bad with that investment, you know that if everything hits the fan, okay, you bought that particular asset below value. So when you go to sell, you should get at least what you paid for or a little bit more because you bought below value. But if you buy above the value, then you're just opening up yourself for all kind of different ones. I'll give you a quick example. Back in the 50s or 60s, I want to say, MetLife, the huge insurance company, bought land and developed an apartment complex right in the middle of Manhattan. Actually, I'm not too familiar with New York, but I think it's it's in Manhattan, but I think it's right on the whatever, is that the Hudson River? One of those, right on the water. Huge apartment complex. I'm talking like 5 buildings, 300 units per building, massive, right? This is back in the 50s and 60s. Right during the heart of the 2008 crash, okay, I want to say it was like 2007, or it might have been in 2008, but it was before the whole real estate market toppled over. They started marketing their property for it to be sold. Every big name real estate company or investor during that time bidded on this property. I mean, it was the creme de la creme, if you will, and everybody wanted it. So long story short, one of the big time real estate groups bought the property. I think they paid $5 billion for the property, which was a record at that time, $5 billion. Now, again, they're buying at the height, okay? A year or 2 later, that property went into foreclosure, okay? Because their cost basis, even though the property was in an awesome location, probably couldn't get any better location, they paid too much for the property. And it was during the height of a great recession that was getting ready to hit. And they had all these lofty projections and expectations and all this cash flow, metrics. And none of that came to fruition because their cost basis was way too high. So I'm saying that, again, I've said this in other videos as well. You can buy a really good company or asset at a really bad price, and it could become a really bad investment. Okay, so your cost basis is number 1. All your metrics that you put into your research of where you want to buy your particular property, make sure that cost basis is either at value or right below value, so that way you shouldn't lose. Okay. Number 2, love thy neighborhood. Okay. You want to feel good about now granted, you're not going to live in the neighborhood. It's just where your investment is going to be, but you want to feel good about the neighborhood when you pull up in there, because you never know. You might want to bring on investors later down the road, and you want to be able to, I don't want to use the word pride, but you want to have, you want to feel good about your investment, and you want to feel good about the area that you bought in. So that's number 1. Number 2, love thy neighborhood. Of course, all the different statistics that go into the neighborhood, the schools, the crime, and all that. You want to flush all that out. But more importantly, you're going to buy your investment property on logic, cost basic. You're going to do all your metrics, and you're going to buy on logic. But you're going to hold that property in emotion. You're going to be emotionally tied to your investment. You're going to, I hate pulling up to this neighborhood. I'm sick of this neighborhood. Maybe your cash flow projections didn't hit to a T. So now everything else is going to, piss you off about this neighborhood if you don't love it. So you want to get to a point where you love your neighborhood, okay? Again, you're not going to be living there, but you are going to be spending time there unless you're completely outsourcing the property. But eventually you're probably going to want to bring investors on, and that might be a property that you want to bring people on. So you want to love the neighborhood. Lastly, in the last quadrant, I call it bye-bye. exit strategy, okay? Now, I know this is gonna sound a little weird, but you want to know or have an idea who your potential buyer is gonna be for your property even before you buy it. Okay, even before you close on the deal, before you sign your name on the paper, you want to have an idea, and it's probably a good idea to put it on paper, but you want to have an idea of what your potential buyer is going to look like. Is it going to be a doctor? Is it going to be, a group of investors? Is it big enough to where, an insurance company wants to take you out down the road? You want to have that idea in mind because that's really going to drive, the other two quadrants as well, having that idea and what things you need to do to get it prepped for this particular buyer. If you're going to sell to mom and pop, maybe you don't need to go in there and tweak some of the things that you would if you're going to sell to a big investor group or insurance company or somebody with big dollars. So that feeds into the other quadrant. So you want to have a sound exit strategy. Always remember this: when you're buying investment properties, you're not going to hold on to those properties forever. There's going to be a time, sooner sometimes rather than later, but there's going to be a time, even if it's your first and it's my baby and I love it, there's going to be a time where you're going to offload that property. So you always want to have an exit strategy in play, ready to roll. The 3 quadrants of real estate investing. Thanks.